In this week's episode of the Stockscores Market Minutes, we're going to discuss whether the market is set up for a rally or a crash as we go into the fall. I'll do my regular weekly market analysis. We're going to look at the day trade of the week on BBIG and how I found it. Plus, we'll look through the market sectors to figure out what sectors are going where. So, stock market crash or rally? Well, on the crash side, we have a few concerns. The market has been going really straight up since last March when the COVID crash happened, and some will say it's a little overbought, extended, risky, that sort of thing. We also have the seasonality factor. September is notorious for being the worst month of the year in the stock market. And then there's just concern about where the inflation is going to go. What is the Fed going to do to combat inflation? Now, on the plus side, we have things like the upward trend is still intact. Earnings are growing. Earnings last quarter were higher than last year. We've had a nice small cap stock recovery in the last week or so. There's just good upward momentum. Ultimately, I judge this question with the chart. And I think that is the simplest way to do it. I'll tell you exactly what to watch for to see if there is a crash coming. Now, this is the S&P 500 chart, which I prefer to use. And notice that we've got a linear upward trend. Now, crashes usually come when there is a parabolic trend, when you can see it curving higher, because that's the buyers chasing the market higher. They chase it too high and it corrects backward. We don't have that. We are in a very nice linear upward sloping trend. Until we break that trend line, there's really no reason to be concerned. Now, of course, a break of the upward trend line could happen any day, and there's nothing to say it's happening now, so therefore, I'm going to vote for rally as we go into the fall. One thing I noticed last week was the market was very strong in the small cap sector again. We had a lot of stocks in that small cap sector breaking their downward trend lines, and that's the first step to a reversal. That sector has been pretty weak the last few months, and that break in the cycle of weakness is a positive sign for the fall. All right, let's get into this week's market analysis with the US markets, and starting off, we have the chart of the S&P 500. This is the 30-day, 60-minute chart just to give us that short-term view, and we had a nice upward sloping channel that was broken for a few days, but we've broken back into the channel, and so we have to get back to optimism. Last week, I was neutral because of that. That was a bit of a concern, but the market snapped right back. Long-term chart, nice upward trend. No reason to be concerned yet because it is a linear upward trend and the trend hasn't been broken. When the trend gets broken, that's when you need to be concerned because that leads to downward markets. We don't have that here. It's a nice upward sloping linear trend line. On the NASDAQ 100, reaching to new highs, a little bit more volatility in the NASDAQ 100 than in the S&P, but nothing wrong with that. That's how we make money as traders, is off of volatility, remains an optimistic chart. This is the chart I'm actually most interested in because the stocks that are fun to play, those lower price stocks, they have been, I would say, lagging. Well, they've definitely been lagging the bigger market. The large cap stocks have not or have outpaced the small cap. We've been in the sideways range for a while. We made a nice bounce off of support in the last couple of weeks, last week, and now had a really good up day on Friday. I think we're going to go back to the highs, retest them, probably get stuck up there. So expect the IWM to stall around 232, but it's certainly a better market last week than it has been for most of the summer. Canadian markets, we're still stuck in a little bit of a sideways range with some volatility. So I'm going to keep my rating on that market at neutral. The long-term chart, though, is still in an upward trend. No break of the trend line, so we'll stay bullish there. TSX Venture still lagging, not out of the ordinary for this market through the summer. It should start to pick up in October, so we'll keep an eye out for that. But for now, I think the TSX Venture stocks, generally got to be careful with them. On the currency side, the US dollar had that breakout 2 weeks ago. Last week, it gave back most of those gains. So I wouldn't say it's a false breakout yet, but certainly not what you would expect after the move from the cup and handle pattern, not last week, but the week prior. So a little bit more negative on the US dollar than I was last week. Bitcoin has made a nice rally over the last, say, 6 weeks, and it's come up to the downward trend line. And this week, it closed below its open, which is actually what you would expect to happen at that price level. So we'll see if we now roll over and head back down, or if we pause here for a little bit and break up. What's most likely to happen? Well, because the trend line has already been broken, we're more likely to go down from here. But I want to see some confirming signal. I like to see a bad week telling me that the sellers are taking back control. If we instead get a good week and break that downward trend line, then we can be optimistic for a move up to the highs. Ethereum, another one of the cryptocurrencies, kind of a similar situation. It seems to be stalling in its strength, and I think no real reason to trade it on either side right now. Commodities, gold had a good week last week, especially on Friday on the heels of the speech by Fed Chair Jerome Powell in Jackson Hole. That helped gold for a one-day run, but it hasn't broken the downward cycle on the gold chart that has been in place since last summer. On the oil side, we also had a pretty good comeback week, and that's a positive. Keeps the upward trend line intact, but we ultimately need to get through that resistance. I think we may run up to that resistance and get stuck, so we'll keep an eye on that for the weeks ahead. On the fear chart, really no fear, so no concern among investors that there is a big crash coming. My ratings then, to summarize: bullish on both time frames for US stocks, long-term bullish, short-term neutral for Canadian stocks, long-term and short-term neutral for gold, and oil neutral and bearish. I would actually change my bearish rating there to neutral on oil. It's made a nice little comeback last week, and we could see it improving. Stock markets made a comeback last week, led by a recovery in the small cap stocks, which is a good sign for retail traders. Now, this sets up well for improved trading conditions in the fall. Gold and oil also bounced back, but each of those are still below some resistance, so we shouldn't get too optimistic on commodities. Crypto is also hitting some resistance at those downward trend lines, may reverse the recent strength soon, and keep an eye out for that. Fear is relatively low. All right, let's go to the day trade of the week this week. And this week, I want to show you my analysis screen, the way that I find all of my day trades. This is also how we find them for my active live service, which you can learn more about at Stockscores.com. So I run a piece of software called TradeStation, awesome software, highly recommend it. And it allows me to write my own indicators, which I think is important, because if you do what everyone else is doing, you will get what everyone else gets, which tends to be average. I don't want to be average as a trader. I want to beat the market. So while everyone is using things like VWAP and MACD and things like that, I want to use my own concoction. And my own concoction is something called an action candle, which is what this screen looks for. So there's a lot going on in this screen. Let me explain it to you quickly. This page, or this little window right here, is 2-minute action candles. So it shows me all of the stocks making an action candle on the 2-minute bar. This does so over here on the left on the 13-minute bar, which is what I use for swing trades. Now, I have another strategy called a pullback play, which I use this screen for. We won't talk about that one today. And then finally, I have one that I call a superhero, which we use this screen for over in the middle there, right here. And that is stocks trading with very high volume and abnormal behavior. We have another strategy called a wave, which we use that screen for. So we're getting lots of data in real time using my custom indicators to identify stocks. So this week, I'm going to focus on BBIG, which made its action candle at 9:32 and required a position size of 660 shares for every $100 of risk. So if you wanted to take $200 of risk, then you would buy 1,320 shares. Now, 660 shares would cost you $2,376. That's before margin. Because the stock was over $3, you should be able to margin at 3-to-1. So take that number, divide by 3, and that gets you your capital required. So that's where I get all these numbers that I show you every week. It comes off of my algorithms in Active Live Screen. And it's not, gut feel. It's just based on math. And I've tested it over tens of thousands of signals, and generates pretty good results year after year. So for $100 of risk, you buy 660 shares. As we said, that's $2,376 of capital. You can margin that, so you only have to put up a third of the capital, so $792. This trade at the end of the day finished the day at 11 times risk, which was an $1,100 gain for 138% return on the capital required. Now that is the day trader strategy. That was based on this action candle right there. We also have a strategy called a superhero, where we look for these action candle or strong price breaks on stocks that are trading abnormal volume. And in this case, we had a break from an ascending triangle pattern right there to just before 12 o'clock. And that was another good buy signal to get in that stock. You know, this one, I would rate that a 6 out of 10 because it made quite a large price gap. It's always a little bit worrisome. What I teach is to wait for a second signal. Got a second signal there, but I actually like this entry the best. That was the superhero strategy entry, and you saw that on the screen before. It was also on that super alpha list. All right, let's do a little something different this week. Normally, I run a market scan on Stockscores. This week, I'm going to use the slideshow chart viewer on Stockscores to take a look at the sectors. I'm going to look at the 10 big S&P 500 sector ETFs, the ones that represent different sectors of the market, like the financials, the utilities, that sort of thing. We'll just do a quick read of those groups to see which groups are strong, which groups are weak, and which groups maybe have the best potential. This is something that you could set up yourself. You just create a watch list using the symbols of any group of stocks. In this case, I've used the S&P 500 sector spiders. Just Google sector spiders, you'll get a list of them. So this is the financials, and you can see the financials are in a good upward trend, and they broke out last week, so the financials look more likely to go higher than lower. On the metals and mining, well, we had a nice upward trend, which was broken, and now we're in a bit of a consolidation pattern. By consolidation, I mean basically going sideways. If the market can break up from this pattern, that's good. If it breaks down, that's bad. For now, it's neutral with a slight optimistic bias because the trend into that pattern was up. Now here's the energy sector, and you can see that we had a nice run. We broke that upward trend. We've now been building a falling top. I'm watching for a breakdown through 45 on the XLE as an indication that oil stocks are going to go lower. On to utilities. They are showing some strength the last few weeks, but they're going to likely get stuck at those highs. In fact, you could argue that they did that last week. So I'm neutral to slightly optimistic on utilities. All I'm doing here is applying basic chart theories, which of course I teach in the different courses that I do. There is the consumer staples sector in an upward trend. But what you should notice if you know how to read charts is that that is something called a rising wedge pattern. What that means is that the bottoms are rising quicker than the tops. What does that mean? Well, essentially when the buyers are strong, and then the weak sellers are strong, and then the buyers are strong and the sellers are strong. The buyers are strong, sellers are strong. Notice that each time the buyers are strong, they can't push the market up as far as they did the previous time. The show of strength is getting less and less and less. And that is why it's actually a bearish pattern. Now it's only bearish if the upward trend line is broken. So consumer staples look healthy, but I would be careful and watch for a breakdown in that group. Materials, this is essentially, commodities, broke the upward trend line, building a little bit of a falling top now. If it breaks down through 80, that would be bearish. On to industrials, had a good run, stalling the last 4 or 5 months, but actually building an optimistic pattern. That's called a little ascending triangle. And if it can break out through 107 or so, then it should continue the upward trend. If it were to break down through 100, then we got to get a little bit cautious. Healthcare, you can see this is a very strong sector and led largely by stocks like Pfizer, which have done really well with vaccines. And you can see the trend is getting parabolic. That is actually a worrisome sign because when trends go parabolic, they often pull back sharply. So I would be cautious with the healthcare stocks. They're not showing any sign of weakness yet, but they are getting a little bit overbought and therefore susceptible to profit taking. Technology been the strongest big sector this year, and you can see that it's in a strong upward trend. Stocks like Microsoft, Adobe, these software stocks really leading the way, and no sign of weakness, but getting a little extended. I think it's a risky sector. And finally, the consumer discretionary. You can see that it is in an upward trend, but it's been a little bit slow lately. Building optimism, or it has optimism. We know that because there are rising bottoms on the chart. If it can just break out, then it can head higher. I think that it's something to keep an eye on. Probably good opportunities there, but you got to be selective because many of them will have already moved up a lot. Well, I hope that you enjoyed this week's Market Minutes. If you did, hit the like button, subscribe to the channel, tell your friends, tell your enemies. Most importantly, next week, trade well.